Hello, my name's Kurt. I'm a value investor, and a few months ago I started a portfolio called the Value Investing $1 Million Challenge portfolio. And the goal of this portfolio was to start with $2,000 and add $200 every 2 weeks, and over time using value investing principles to grow the portfolio balance to $1 million in about 10 years. Now, of course, depending on the exact returns we get, this could take as long as 15 years or it could take less than 10 years. And something that I've had to do so far in order to keep pace with the schedule of the portfolio is to up the contributions to $250 every 2 weeks. So I hope that's not a huge deal for everybody if you want to follow along. Obviously, if you copy what I do, then regardless of how much you contribute, you should still aim to get good returns and should still do well over time, assuming that my portfolio works out well. Of course, that's not a guarantee. So let's get into my second major update of the portfolio, and I'll review my positions and some research I've done with some context moving forward. First, I just want to cover the main topics of today's discussion. The principles of valuation that I use to determine whether a stock is something that I should buy and how underpriced it is in the market relative to its intrinsic fair value. I'll also go over general market conditions, and I'll also include all of my current portfolio positions. I'll also address the performance of the portfolio since I've started it and how we're doing on track with the schedule to reach $1 million in 10 years, which, by the way, requires about a 50% per year return. So we're shooting for the stars here, but we feel like we can do it with the value investing principles: deep value, serious undervalued stocks, buy and hold until they realize their fair value in the market. Last but not least, I'll go over a short list of potential buys in the near future, depending on market conditions and where the price of those stocks go, but those are stocks I'm really looking closely at buying. And I'll leave with a warning of not getting caught into value traps, which is something that I've already started to learn through the course of this portfolio. Is yes, we're looking for low PE companies and we're looking for some of those metrics, but sometimes they can be deceiving. So what are the main points that we can tell whether a stock is a value trap? So let me start with the principles of valuation. Number one is that we look at free cash flow, and of course we look at free cash flow per share. Per share just means that we're taking into account the dilution that could be happening through issuing new shares and diluting the current shareholders. So we have to look at the number of shares outstanding. And so when we look at free cash flow, if free cash flow is growing, but shares outstanding are growing just as fast or faster, we're not really gaining any ground as a shareholder. So again, on the per share basis, we look at free cash flow, which is the cash from operations minus capital expenses. It's very close to net income, but the huge difference is that capital expenses are those expenditures that the company needs to procure to acquire property, plant, equipment to keep the business going. The shareholder doesn't have that cash available to them. The shareholder receives the cash that's left over after all that is said and done. We call that free cash flow. The next point is to look at healthy fundamentals. We use a pillar system to assess the predictability, the quality of the business. How confident are we in our predictions of its future free cash flow? Because if the free cash flow is all over the place, it's very hit or miss, or it goes up a lot but then down a lot, we can't really confidently predict the future free cash flow to discount it to present value. And so we could have a huge range of results when we go to simulate the future of this company and then derive a bell curve of its value. So we also look at the quality of the business. What do they sell? What is their moat? What is their return on invested capital? What does their balance sheet look like? I mean, do they have a lot of debt? Do they have cash on hand to pay their bills? So those are big things, because a lot of times when a stock goes down significantly, it's because there's a fear that the company could go bankrupt. And that derives from having lots of debt and not having the predictability and cash flow to offset that debt and to pay their bills. Of course, when we forecast free cash flow into the future, we need to know the present day value of that future cash flow. And that could depend. I mean, it depends on how you want to discount that to today. When are they going to receive that cash flow? Is it going to be 10 years from now or 2 years from now? So we have to have an accurate projection of their future earnings and free cash flow, and then we need to discount that. In doing so, we adjust for money's time value, and we basically use the opportunity cost or the risk-free discount rate, as Warren Buffett likes to say. Although we take a little bit of liberty with that opportunity cost rate, we want it to be a lot higher than just a 4 or 5%, which is the current treasury mark, because we want to acquire much better returns than that. So if we assume that we could get 15% return on our money somewhere else, then we use that as the discount rate to discount all the future earnings of a company. And then if a company's present value using that discount rate is significantly lower than the current price, we know that we have a real winner. And using all of these methods, we look for the fair value of the company, which is the present day value of all the future free cash flow of the company. And then we add the current assets and subtract the current liabilities with some adjustments. And that gives us our intrinsic fair value of a company. And we buy those companies that the current price is well below the intrinsic value with a certain margin of safety to give us peace of mind. And then we sell that stock after its fair value is realized in the market. And once it gets to that level where we feel like most investors should price the business. So now with a little bit of a look at market conditions, because this is going to influence what we're looking for, what types of businesses are potentially going to do well, and how is the general economy looking. We, of course, could be buying in a down market, and of course, we shouldn't expect fantastic results currently. We should expect those results maybe 3 or 4 years from now when everything balances out over time, and that's why we give ourselves a 10-year horizon. So just to keep the context of the market in mind, I commented in a recent letter to all my partners in my research platform that the financial panic of 2023 is the major headline through the current calendar year up to this point. I noted that this is only the beginning of the financial panic. It's unfortunate, but this is something that is expected. I predicted it, of course. I mean, it was so easy to see, and it is the direct result of years of Federal Reserve policy. And there really are only two options from this point when it comes to addressing the bank failures and the state of the economy. Either the Federal Reserve is going to create trillions of dollars of liquidity and money creation, which will inevitably cause more inflation, or we will accept the failure of countless more small and regional banks, which would be detrimental to our economy, of course, because yes, maybe a lot of the money would push into the big banks, but you'd have a lot of people losing deposits, as the FDIC cannot backstop all of the over 250,000 deposits in the entire country. And I'm not saying every bank in the country would fail, but a huge portion of them would, which would create a self-perpetuating cycle where lots of liquidity gets sucked out of the system and credit availability goes very low, and many businesses would, of course, fail at that point without the liquidity and credit available to keep their business operating. So you would have a lot of unemployment in that situation. So what is the Federal Reserve going to pick? Trillions more in money creation or countless more bank failures? As you can see in the chart on this slide, I always have predicted that the Federal Reserve cannot get below $8 trillion on their balance sheet. They can't sell off assets below $8 trillion in this part of the cycle without having some sort of crisis requiring them to, again, acquire many assets. We saw a big bump with that with this banking crisis because the Federal Reserve opened the window to buy all sorts of bad assets of treasuries that banks had in their hold to maturity portion of their balance sheet. So this Federal Reserve balance sheet is going to continue to increase as the Federal Reserve has to bail out banks, basically. And so we look here on this slide at the employment in the United States. One of the main things holding everything together so far seems to be that even though we have soaring prices and even though consumer metrics are really struggling, we have high employment and low unemployment. And I noted in that letter that stagflationary recessions, which I say we've been in one technically since January 2022, because remember, first quarter and second quarter of 2022, we had negative GDP year over year in the quarter. So even though that balanced out in quarter 3 and 4, if you use appropriate cost of living increase rates or CPI deflators on the GDP, the real GDP has been negative ever since January 2022 for sure. So we've been in a stagflationary recession since January 2022. Stagflationary means even as people are losing and getting laid off from their jobs and moving down the employment ladder, we still have inflation that is weighing on people's consumer behavior and they're not able to enjoy a high standard of living. In essence, what we're saying is that inflation is significantly higher, cost of living increase is significantly higher than wage increase, and therefore people's standard of living is getting squeezed, especially on the margins. I noted that during stagflationary recessions, the economy usually maintains a fairly low unemployment rate for a decent amount of time. But I also said that these historically low unemployment rates, which are as low as 3.5% in the month of March 2023, will not last very long. As we've already seen many layoffs, we're going to continue to see layoffs as corporate earnings continue to come in slog after slog below expectations, and companies are going to have to make really tough choices. So with that in mind, let's look at our current portfolio positions in the $1 Million Challenge portfolio. Currently, I have 6 positions you can see: Vista Outdoor, Brazil Agro, Flexible Solutions, Medifast, Ally Financial, and Connect One Bank. Now, I must say, going into the financial panic, I was overweight in financial banks. I had the two, Ally Financial and Connect One. I thought they were severely undervalued. I still think Ally is significantly undervalued, and I think Connect One Bank is still decently undervalued. That is, if Connect One Bank doesn't have a major crisis during this panic, which I took a deeper look at their balance sheet and I think they're okay. I mean, I adjusted for all of their hold to maturity portion of their balance sheet on their asset side. The big problem with Connect One Bank is they have lots of commercial loans in their assets, and there's a lot of news out there that the commercial loan sphere is going to have a lot of pressure over the next year or two as lots of loans come for refinancing. So keep an eye on Connect One Bank. I bought a major slog of shares after the panic when the price dropped, but at this point, I think I'm hands off on Connect One. I'm just going to let those shares ride, and hopefully we recover to a decent position, hopefully somewhere closer to $25 or $30 a share, or even higher. Now, Ally Financial, I think Ally has a great brand. They're an online bank. They have low costs, and I think Ally is going to be fine. I think we just need to wait out the storm on Ally. So I may even continue to buy Ally Financial if the prices continue to stay depressed. So it's needless to say that the entire portfolio has been significantly impacted by the financial panic based on those two positions. But this is something that we just have to give time. You don't sell when things go down. If anything, we would buy more. But of course, I do want to use a little bit of wisdom. I bought more Connect One Bank, but I don't want to go crazy with it. On the contrary, there are other really good opportunities summarized by these other 4 stocks that I own. Vista Outdoor, I think, is amazing. Brazil Agro, fantastic. Flexible Solutions is a tiny micro cap, but I think this company has really good value, and so the risk to reward ratio for me is really good. And Medifast is one of those weird ones. If you know anything about Medifast, they own the Optavia brand, which is a weight loss program which uses coaches and selling products. So it's a little bit multi-level marketing. It's a little bit pyramid scheme. And I've gone back and forth about how I should deal with that, first of all, financially, and second of all, morally. I mean, I don't like pyramid schemes, obviously, but if the financials are telling me that this company is working really well over a long period of time, then something is happening there that's actually probably beneficial to most of their consumers. I'm not going to say it's a perfect business, but I'm going to say it's severely, severely undervalued, and it's got fantastic fundamentals. So Medifast is a stock that I've added recently, and I feel like it's going to make the majority of the addition to the portfolio going forward until there are better opportunities. As you can see, the total net fundamental value is almost $20,000. What do I mean when I say net fundamental value? Is after I've valuated all these stocks and I've come up with their intrinsic fair value and multiplied by the number of shares I own, that's what that is. So if the market were to recognize the fair value that I think that these companies are worth, then the portfolio should be worth $20,000, and that's off of a cost basis of somewhere around 6,500. So we are sitting very well, but we haven't realized any of that yet. In fact, the current market value, which you don't see anywhere on the slide because I always think in terms of fundamental value, but the net market value is somewhere around 6,700. So we're not sitting significantly above the capital that we've deployed in the portfolio so far. The cash position is only $85 as I've really deployed the capital as I've deposited it into the account. And the realized profit and loss, that is the money that we've gained from selling positions that we've previously held, is $451, which is pretty good. Some of those include Foot Locker, which was one of the first positions I had in the portfolio, which I exited fairly quickly, and a couple mining stocks like Caledonia and Anglo American, and a couple other companies that I entered for a short time and for the most part have sold with a gain. The largest of which is Ternium, which is a steel producer that I owned for a long time in this portfolio, but since prices have been really high and it's a cyclical business, I've sold out of that position. But let's see what the future holds and perhaps I'll buy it back. This is the performance of the portfolio relative to the S&P 500. Now the S&P 500, as you can see, in an annualized performance since we began this portfolio is at negative 1%, which is almost laughable because after all this time, it's basically where it was when we started. And this portfolio hasn't done that much better, but you can see annualized we're at plus 3%, way, way, way below our target. But of course, we're in a down market. It's really tough for us to have on paper positive returns. But keep in mind, if we were to realize the intrinsic value of all the companies we hold, we would be way, way up. And so that's what we have to keep in mind in the long term. But so far, the delta in performance is plus 4%. We're doing 4% per year better than the S&P 500. The major point that I want to make is, in fact, that huge negative bar that you see in early March was due to the financial panic when bank stocks really settled downward. And you can see that that's had a major negative impact on our performance. In fact, that was one of the very few times that we had in a 2-week period worse performance than the S&P 500, and it was a lot worse because we had those 2 bank stocks. So hopefully those correct over the long term, but into the future, we should do better as we take a careful look at what we're buying before we buy it, and hopefully we don't encounter huge issues like that again. And here's another view of the performance of the portfolio. In this graph, I have the deposit amount every 2 weeks, which is $250 at this point. I have the beginning amount and closing amount for every 2-week period. And you can see at one point back in January, we were sitting well above the beginning amount. We were actually gaining a lot of money, and we were keeping pace with the schedule of what we needed to accomplish to get to that $1 million in 10 years. But at this point, the schedule rate is 21% higher than where we actually are. So we have a lot of ground to make up, and we can do this through a couple of means. We could either increase our contributions every week to try to nudge us back closer to the spot we're supposed to be. And again, remember, the further we fall behind, the tougher it is to come back. Or we could wait for better performance. So it's that balance. I may make the executive decision to raise the contribution amount again, maybe to $300 every 2 weeks, which would be like almost $650 every month when you go over the whole year. But I haven't made that decision yet. And so far, we've done an okay job of recovering a little bit since that early March period where our close amount dropped a lot below our beginning amount. So that's our performance. We're moving in the right direction with our contributions, obviously, but we have some decisions to make and we have some ground to make up. Here's some stocks that I want to share with you that are on my watch list. To me, these are really good quality companies that are a decent bit or significantly below their intrinsic fair value that I would consider adding to this portfolio to beef those returns. The first one is Nexstar Media, which is a stock that I've covered on this channel before. I have it in my main portfolio, in my personal main portfolio, and that is an extraordinarily great fundamental, significantly below fair value. In fact, I have a 3.4 price under value ratio, or rather it should be value divided by price ratio, right? But my price under value ratio of 3.4, it implies an annual return or that equivalent discount rate to today's price of 30%. So Nexstar Media is high up on the list. Dropbox is the next stock, which I think is a steady growth story. I mean, Dropbox has done a really good job of churning out positive, growing free cash flow. And you think of Dropbox as one of these tech-oriented stocks, but it has had a profit now for quite a few years and free cash flow, steady free cash flow for quite a few years. They rely on converting free use customers to paying customers, and as subscriptions grow and people like integration of storage on all their devices, I think Dropbox has a good business model, and it's proven it's able to have great recurring customer subscription. So the value is 1.7 times the price, and I think we could buy this one if we see a decent entry point on the price. The next stock is a really small cap stock, which is Quanex Building Products, ticker symbol NX, 1.5 value to price ratio, with an implied annual return of about 25%, which is great. And I think I would buy this one if it was below $20 per share. It has had decent free cash flow growth, but the free cash flow is not super consistent like Dropbox. It's a little bit cyclical, so we have to wait for the right moment to buy this stock. Ternium is the last stock on my watch list, and as I said before, that's a stock that I've held for a majority of this portfolio, but I've recently sold out as it went above $40. The main chunk, the final chunk that I sold out at above $42 a share, and now it's pulled back to about $40 a share, somewhere around there. So I would buy this one if it got back into that $30 to $35 range or lower. And keep in mind, this is a cyclical business. Its free cash flow is on its way down. So we have to keep an eye out on that and constantly adjust whether we think the value is worth the price we're paying. And even though we see that 4.8 price under value ratio, that could be really manipulated by sharp drops in the market. I mean, if we run the analysis of fair value on Ternium in a couple quarters when financials have really dropped, it's going to create a totally different answer. So we have to keep our eye on that one. But if it got down low enough, I think I would buy Ternium again because I think it's a fantastic business. For a cyclical business, I think it has great consistency in its earnings. And I think over the future, it's going to be great. The last thing I want to leave you with after reviewing everything, the update on the portfolio, remember we have that plus 3% annual return so far, which is not very good, but that's what we're dealing with, and we want to improve it. We have almost $20,000 in net fundamental value, so again, we need to wait. And like I said early in this challenge, we hold these companies, we marry to them. I mean, we wait for them as long as it takes to get to their fundamental value. And unless something major happens in the company, we are going to hold these positions like Connect One Bank, like Ally Financial, even though they're going through hardship in 2-3 years when the financial industry is maybe back on its feet through whatever the Federal Reserve decides to do, or once the panic has kind of subsided, we should do better. But that's the nature of value investing. Sometimes you just have to hold to your convictions, and you can't be persuaded by short-term moves in the market. That is the cardinal sin number 1 in value investing. But before we leave, I want to leave you with some advice in detecting value traps and staying away from businesses that, even though they have a PE ratio of 2 or 3, or even if it looks really good on paper, something could be happening behind the scenes here. We don't want to get into companies that will tank, and we're buying into them at their peak and then they end up tanking. So the first thing you want to do with every business is look at their balance sheet and start to learn what a good balance sheet looks like. Look through many balance sheets. Look at their cash on hand. Companies that are flush with cash, the balance sheet is telling you that something good is happening with this company. They have so much cash coming in every quarter, every year, that even as they're investing in the company and paying it back to shareholders, they still have a huge balance they don't know what to do with. Those are fantastic companies, but there are not many like that out there. And again, look at companies' assets. Look at their goodwill, their intangible assets. Does that make up a high share of their total assets? If so, beware, because goodwill is it's something in the imagination. Goodwill is not an asset that can really be realized. Also, look at growing inventory levels. If all they're doing is increasing their balance sheet by taking their cash flow and buying more inventory, but they're not selling through that inventory, that tells you something's wrong. They're not able to sell their products, and they're doing a little bit of an accounting trick there. Look at their property, plant, and equipment. property, plant, and equipment is something that will sell probably 50% to 60% at the sticker price if the company really had a struggle and had to realize those assets. So always detract from the assets of the company accordingly, and always look at their debt. Is their current debt really high? What's their cash to debt level? Is their long-term debt really high? And remember, we have interest rates rising, so as they refinance that long-term debt, it's going to be bad. So a company with assets to liability ratio of 2-3 times, that is a fantastic business. And we want to stay away from companies that the debt could become a problem, because that could tank the stock price easily if they have hard times. And we are entering a recession. So companies that have great balance sheets are going to survive the recession a lot easier than companies that have wacky balance sheets. The next thing is to look for cyclical businesses and keep your eye on what can happen in the future with wisdom, rather than just looking at what happened in the last few years. Yes, free cash flow could have grown 25, 35, 50% per year over the last 3 years during COVID, during all sorts of things. But look at the cyclicality. Look at long-term free cash flow trends. And use extra caution when you're looking at cyclical businesses like raw materials, energy, mining. Those are business cycle-based businesses. Even home building, like your home builders, if we enter a housing recession, then those guys are in trouble. So keep a grain of salt when you're looking at all these companies. Do they have a business model that will continue going through recessions and through good times very consistently? Those are the kind of businesses that you should have a lot more confidence in your projection of their future free cash flow. And companies like this that are cyclical, you should use higher margins of safety and really subtract when you're forecasting their future free cash flow. The last thing is, great businesses have good returns on capital. So if you're looking at a business and it's got thin margins, that could turn bad very quickly. So focus on businesses that basically can get return on their money with very little effort. They don't have high cost of doing business. So one thing you need to do is look at long-term return on invested capital. Yes, any company in the cyclical could have great returns on invested capital because they've had high earnings based on external market conditions. But over the long term, have they had a track record of their management deploying capital and getting high returns for it? And do they have declining shares outstanding, meaning they are not just growing their business by share issuing, but they're growing their business naturally? And also look at the weighted average cost of capital, the WACC, WAAC. If a company has great return on invested capital, but a high cost of capital, then you may be looking at a 10% ROIC with a 5% weighted average cost of capital. It's really only a 5% return on capital. So if it has low cost of capital and high return on invested capital, that is the sweet spot. And so that's something I just want to throw in there to look out for. You can find the weighted average cost of capital on companies through a quick Google search. And so that's a principle that I want to start implementing when I look at the ROIC for evaluating businesses, especially in my pillar system. That is the Value Investing $1 Million Challenge portfolio update. I want to just mention that I'm not a professional investor, and that I want you all to do all of your own research and have high conviction personally whenever you buy your own stock. And don't take my word for anything. Everything I've done is just stuff that I am personally doing, and I'm putting my own money into this. So this is my journey, and maybe I can give you great ideas. Maybe you follow along with me and match some of my positions after you've validated that you think that they're good investment ideas. But with that, I wish you the best on your $1 million investing journey, and stay tuned for more updates as we go through potentially a tough time. But remember, no matter whether it's bear or bull market, we invest in businesses that are below their fair value. We use safety factors, we use conservative estimates, and when we project their future free cash flow, if the price is below the current present value of that future free cash flow, those are great companies, especially if they have great fundamentals, great balance sheets, great managements. So with that, if this has been beneficial to you, please like the video and subscribe to watch more videos on stock valuations and my portfolio updates and my commentary about the general market conditions. Best of luck. See you next time.